This is the Daily Market Comment. I'm Marios Hadjikyriacos. I'm Maria Pashurdias. Thanks for joining us at XM.com. A perfect storm has engulfed euro-dollar, which cracked below the famous parity level to trade at a new two-decade low thanks to a deepening energy crisis in Europe and a US dollar that has been supercharged by bets that the Fed might wrestle back control of financial conditions. European natural gas prices have gone through the roof, eclipsing previous record highs after Russia announced it will shut down its main pipeline for another 3 days this month, sending an already undersupplied market into full panic mode. Energy prices at current levels will paralyze heavy industry and crush consumer spending power, almost ensuring a deep recession that the ECB cannot deal with, since it also carries inflationary implications. The latest PMI business surveys add credence to the view that the Eurozone is in dire straits, as the persistent weakness in manufacturing seems to have infected the far larger services sector in August. Other than a ceasefire in Ukraine coming out of the blue, it's difficult to see what else can turn the euro's fortunes around. On the other side of the euro-dollar coin, the US dollar has gone berserk lately, smashing everything in its path. Without any significant data releases, the latest surge in the greenback likely boils down to positioning adjustments and hedging ahead of the Fed's Jackson Hole Symposium later this week. It seems to have dawned on investors that the Fed isn't happy with market pricing for rate cuts next year. That expectation is keeping Treasury yields artificially low, making life harder for a central bank that is still in inflation-fighting mode. Speculation is running rampant that Chairman Powell will attempt to right the ship, perhaps by stressing rates will remain higher for longer. Another currency that's been run over by the runaway US dollar train is sterling, with cable briefly falling to new post-pandemic lows as the souring mood in equity markets also inflicted damage. There was another bruising session for Wall Street. The S&P 500 lost more than 2%. There was no news catalyst behind this sell-off, which instead seems to have been driven by a spike higher in Treasury yields that compressed equity valuations, and the recent short squeeze simply running out of juice. Traders are likely front-running the Jackson Hole Symposium, where the Fed might attempt to retake control of the narrative and tighten financial conditions. This was today's Daily Market Comment. Thanks for joining us at XM.com.